Third time's a charm. That's what we're going to go with right now, guys. Sorry. I have to apologize to you. I've wasted my own time. Here's what's going on, guys, with some technical difficulties getting in the way. Rates have been getting smacked this week. It's been unreal how crazy it's been. I went to lunch Monday, and the market was down 61 basis points. That's not good, guys. Down is bad in this instance. And normally it's like 15 to 20 on any given day. 61 is a big move. I come out of lunch on Monday, down 172. Holy smokes. That's got to be two top five, like the biggest I've ever seen intraday without like the world exploding. That's insane. So you guys can see that big movement here Monday. That's, four, 2, 3, 4 back. It's that big red one. Then, and the reason why was because Britain basically said, oh, we're going to try to fight inflation and do all this other stuff. We're going to do quantitative tightening, and we're going to start, selling off what they call their gilts. I guess that's the equivalent of their 10-year treasury. And the market just freaked out, globally freaked out. We freaked out because they freaked out. And then they come back 2 days later like, hey, just kidding, we love you. And we're going to go ahead and just do quantitative easing, like total 180. And then it calmed everybody down. And then all of a sudden today, which is not being reflected on here, they're getting beat back up. So it's unbelievable, just the reactionary part. And so earlier this week, the rates were at 7%. Now, that green day we just saw where the market come back down, now they're at 6.7. But holy smokes, guys, it's crazy, the volatility. So you're at 6.7 with 0.9 points. So basically a full point to get to that 6.7 right now. I did say earlier in this year, and it wasn't that I'm like that smart. It's just I watched, pay for a lot of services, all this stuff. We called 7% around February, March. Here we are at 7%. I think it's going to continue that way for the next 60 days. Here's why. I think the inflation is going to peak. The November report is my guess, and we'll see if I'm right. My guess is going to be that November is the peak. Here's why. You guys have seen this before if you watched this with me. Look at on the left side, guys. June, July, and August. Those are all the yellows. Those are all past. They have gone away, right? So if you guys look at the August on the left, 0.2, this last August, which is the report we get in September that we just got where inflation's higher, August now is a 0.6. We replaced a 0.2. So of course, inflation is going to go up. When you drop off a 0.2 and you load on a 0.6, that number is going to be a bigger number. September, so that means next October, so next month, and if a couple of weeks, whenever it reports in October, you're getting rid of a 0.3. I'm willing to bet you might see something again, kind of like a 0.6 reading. That means inflation will probably go up. The market won't like that. You'll see rates react. It won't be until October when we drop off a 0.6. And maybe we'll put on a 0.6. That'll at least be flat, but maybe by that point, some of these Fed hikes will kick in because you guys are starting to see it, and we'll talk about that in a slide or two. But if they can load on a 0.4, it'll show inflation going down. And so look at November, December, and January and February. Like those are all 0.5, 0.6. So that's about where we were in August from an inflation standpoint. So if nothing else, it goes sideways. But I do think with all the Fed's movements, the people, unfortunately, are losing their jobs. And one more screen, I'm going to show you how they're not spending as much money. I think that's the part that says come November, when they raise 0.75, you're going to see that that's going to basically do the job. So I think inflation will peak. And when inflation peaks, our rates will peak. And then our rates will start coming back down. I've been saying that I think they're going to be back in the mid-4s, or not mid-4s, but in the 4s sometime in the next 12 to 24 months. I actually just saw it just this morning, so I didn't put it in these slides. But Fannie Mae had some sort of article saying that they think 4.5. So I'm not alone, guys. I got Fannie backing me up. So here's what I'm saying as far as just kind of things coming down. Well, first of all, look, this is CNBC. Home prices cooled at the fastest pace in history. Guys, look at the bullet points. The top 10 and top 20 cities here. We're still appreciating at 14.9% and 16.1% respectively. So 15% appreciation. Yes, it went down from 17 and 18, but who cares? 15% is still hot, guys. So while that's good, and say, hey, clients, we should be buying right now, it's still a great time. There aren't as many buyers because people have gone to the sidelines with rates at 7%. Now it's a great time. Your rate's not forever, but appreciation is still continuing, especially in Dallas-Fort Worth. So get that message out. That is inflationary, but here's why I do think the market's slowing down. Check this out. This is savings, personal savings. How much money does somebody have in their checking and savings account? And it's just showing you how historically you're somewhere between that 5 and 10 range. You guys can see how it jumped to 34% of what people are saving during COVID. Makes sense. There's nowhere to go to spend your money. Couldn't do anything. Well, now look what happened, guys. We are down at the lowest level since basically 08. And if you guys remember 07, 08, that's the mortgage meltdown. Wasn't fun for me. But if you guys look at that, I mean, the savings are low. I mean, it's decades low. And part of that's because inflation is so freaking expensive. So people are now cutting into their credit cards. And here's how I can prove it. Boom. Consumer credit cards. It is at an all-time high, well, all-time, multi-decade high, 30-year high, showing you that people are putting more on their credit cards to make sure they can get by and get by. At some point, guys, credit cards have limits. People will stop spending. They can't spend any more when they don't have any more limits. So when people stop spending, that's what calms inflation. Inflation is too many dollars chasing too few goods. So when all those dollars stop going out of people's pockets, that's when inflation comes down. That's when our rates will come down. So guys, just keep that in mind. And then one last thing, I just thought this was funny. Not funny, but this is my public service announcement, my PSA for the day for birth control. Check it out, guys. 300 grand to raise a kid. So if you got somebody thinking about starting a new family, it's 300 grand to basically raise that kid. So for 18 grand a year, give or take. Now it's apparently up to 26,000 based on inflation. So there you go, guys. That's my public service announcement. But a couple of you, by the way, have asked, and I'll stop sharing my screen. A couple of you guys have asked for like numbers to say how much does it cost to buy down rates, or how much to do a permanent buy down or temporary buy down. I'm working on that, and I hope to have that to you next week. But we got to get some of those things done for compliance reasons to demonstrate how to show that without actually showing a scenario. So we'll get that out to you guys. But thank you for watching. As always, when you think mortgage, think Mark.